Hi, good day everybody. My name is Wai Mun. I'm a fund manager with Phillip Capital. I manage a unit trust fund called the Phillip Master Equity Growth Fund, or PMEGF in short. Been with Phillip Capital for 3 years. Today I will share with you more about the fund and also a bit of the recent market correction, and also how to deal with market volatility. As you know, this year is an exceptional year because of COVID-19 pandemic, and everybody is suffering because of that, because of the lockdown and because of stay at home and because of RMCO and so on. But don't worry, we are in this situation all together. Together we will overcome it. And there's also a Chinese saying that called Wei Ji. Wei means danger or crisis. Ji means 机会 in Chinese, or opportunity in English. So if you combine the two words together, it means there is opportunity in every crisis. I'm not sure about you, but I feel there are a lot of opportunities in 2020, even in the COVID-19 crisis year. With that in mind, I would like to share with you our unit trust fund called the Phillip Master Equity Growth Fund. As the name suggests, this is a growth fund. So we are looking at growth stocks, and we are trying to invest in many of the growth stories in Malaysia. For example, this year we've seen that one of the growth stories in Malaysia is the rubber glove sector in Malaysia. But not only we look at growth stocks, we also have some selected blue chips in the portfolio. So the whole fund is a good mixture of growth plus blue chips stocks in the portfolio. It's quite balanced in the sense. Another feature of the fund is that it's rather concentrated fund. We do not, if we are confident on certain stocks, we put a very high weightage on the fund. For example, the top 5 stocks in our portfolio is 40% of the fund. So meaning that if any of the 5 stocks move up significantly, the investors will benefit because it is a high percentage of the portfolio. Lastly is that the fund currently has quite a high cash balance of around 20%. So it basically means that we are defending and attacking at the same time. In football terms, we have the defender there because you have very high cash balance of 20%, and we are also attacking at the same time. Why attack? Because we are very focused investments. We focus a lot. We concentrate very high if we are confident on certain stocks. For this fund, the past 12 years annualized compounded returns is 9.4% for the past 12 years since 2008, the previous financial crisis. So we have gone through easily 2 crises so far. This year there's a crisis year. 2008 is also a crisis year. This year we are close to almost double-digit returns for the fund performance-wise, which is beating the benchmark EMAS index, which is down about 2% this year. So overall, I think the performance of the fund is decent, reasonably decent, which is to me is quite attractive, especially in the current low interest rates environment. The interest rate is only 1.75%. So if you get anything better than that, I think it's quite a good investment. Recently, we saw the market corrected a bit, so I think some of you could be worried about whether we are going to see a market correction. Also worried about the market volatility. So I want to share with you whether market volatility is good or bad for the real investor, and also how to deal with volatility in the markets. In my opinion, volatility can be a good thing for the investor if they know how to manage it well. So how do we manage volatility in the market? I shall quote some famous investors what they have said about volatility in the market. The most famous investor is Warren Buffett, as you know. So according to him, he says, look at market volatility as your friend rather than your enemy, and to profit from the folly rather than participate in it. So this quote is very applicable this year. In March of this year, if you remember, we saw a very sharp fall in the stock markets worldwide because of the lockdown and because of COVID-19. But I think if we follow what Warren Buffett is saying, he is saying that we should treat it as a friend rather than an enemy. So we should welcome market volatility because it gives us a chance to buy our favorite stock at a much lower price. As you know, we try to buy low and sell high. If you're able to buy a stock at a lower stock price, there is obviously a very high chance for you to make money from the particular investment. Okay, I would also want to share with you about market timing. A lot of people try to time the market by asking questions like, when is the market peaking? When is the market going to crash? But I think this exercise is not a very effective exercise because of the study done by Fidelity. Fidelity has done a study, for your information, about which of their clients have done the best. And what they found out was very interesting because there are two types of clients which has the best returns. And number one, these clients were basically dead. Basically, the dead investors did better than those who were alive. Number two, the investors who forgotten that they actually had an account at Fidelity also did better. So this study basically shows that market timing is not very effective. What is effective is, in my opinion, for the long-term investor to regularly invest in stocks or unit trusts at a regular intervals, either every month or every quarter, whenever you have the savings, which is by doing so, you benefit from the long-term appreciation of the stock market. Okay, stock picking methodology is not a big secret. It's actually very easy. There are few ways we tend to pick a stock. We are generally bottoms up stock picker, looking at the company's specific fundamentals. Because if you have a strong balance sheet, you can survive a crisis. You know, this year COVID-19 pandemic, we have seen that to the extreme that some companies have zero revenues for a couple of months because of lockdowns, because of MCO period. So for a company to survive without any revenues, they must obviously must use their strong balance sheet to help them to survive over the period of zero revenues. So that is why we usually look for companies with net cash position, meaning the cash that they have on the balance sheet is more than the borrowings from the bank, so that they can be well positioned in a difficult year. Apart from that, you also look for companies with high profit margins. Company with high profit margins means that they they get higher profits for every dollar of revenue that they generate. And also, thirdly, we also look for companies with high ROEs, high return on equities. Because usually, high ROEs, companies with high ROEs tend to have better share price performance. And also because we are managing a growth fund, so we also look for companies with very high growth prospects, because their high revenue, because their revenue or their profits are growing steadily and quite fast at a rapid pace. So we look for such companies to invest, because usually the share price would tend to follow the company's profits. If the company's profit is growing at a rapid pace, the share price would also grow at a rapid pace. So these are some of the things we look out for when we pick our investments. Yes, Malaysia has not been doing well for the past few years. As you can see from the KLCI index, it has not gone anywhere in the past 3 years or 5 years or even 7 years. But having said that, there are always winners in the market. Even in a tough market, there are always companies that seem to do well. For example, this year we have the rubber glove players and also the technology sector that is doing well in Malaysia. Rubber glove players because there is a shortage of rubber glove in the market. Technology players because in the pandemic year, the more and more companies are driving up their digitalization efforts, which will increase the demand for technological products, which will benefit Malaysia's tech companies. So every year we'll have some winners and losers. So what we will focus on are finding who are these winners and try to benefit from there. Okay, Malaysia. Recently, we have seen some political uncertainties, higher than usual uncertainties political-wise. So this reminds me of our neighboring country, Thailand, who is also facing a lot of political uncertainties. So it is natural for investors to feel uncertain and uncomfortable when it comes to investing in unit trusts. But as investors, my view is that we should not be too much overly concerned and overly worried about such uncertainties, because yes, in the immediate term, there could be some knee-jerk reaction. Market could be volatile, stock prices could be coming down whenever there is a change of government or change of political parties. But I think that Malaysian investors will, over time, will become more and more matured, and they will get used to such uncertainties and change of government. And with that, they will markets will be pricing in such political uncertainties. And as investors, we would also try to identify companies that are neutral to the government of the day. Basically, they have a neutral position, and they would benefit from whichever political party that is running the government. So this is this in my opinion this is what we try to identify in an investment. So basically that marks the end of my sharing for today, and if you have further information, if you would like to know more of Phillip Capital, you can always visit our Facebook page and also our Instagram page, and also don't forget to talk to our financial advisors who are readily available to help you, to advise you about the different products and also offer you investment advice. Thank you very much. Thank you for listening, and I truly hope that you are able to benefit from what I shared today, and also don't forget to take advantage of this crisis year to invest for the long term. Thank you. Sex.